Did you know that if you tank your credit, you'll actually get a better mortgage rate? No, that's not right. In today's video, I'm going to clear up any confusion about whether what you're hearing is correct or not. Are people with higher credit scores getting penalized to help people with lower credit scores? And whether or not you should stop paying your credit cards altogether just to get a better mortgage. Hi, I'm DJ Tenhove, and I've been a realtor since 2008. My team and I have helped thousands of people just like you buy their first home, upgrade to their dream house, and downsize within or outside of New Jersey to be closer to family, with hundreds of repeat clients and 5-star reviews to prove it. What the heck is changing, and when is it changing? So on May 1st, 2023, the FHFA, or Federal Housing Finance Agency, is literally upending the LLPA pricing matrix. Is that enough acronyms for you? What the hell is the LLPA? I'll get to that in a second, but before I nerd out on you, let's just explain what the change might actually mean for you as a buyer. The changes they're making mean that if you're a borrower looking to buy a house and you have a credit score over 680, you're going to get a worse deal. If you have a credit score under 680, you'll get a better deal than you would have before May 1st. So back to the myth we're trying to answer. Are better credit score borrowers being penalized to help lower credit rate borrowers? Based upon the information I just shared, yes. But it's not that someone with a credit score of 680 is getting a better deal than someone with a score of 780. It's just that you're either getting a better or worse deal than you were getting before the changes come into place on May 1st. Okay, so how many people might this affect? Well, Experian reports that the average credit score in the country is 710. So the average American will be affected. Oh, and only 35% of Americans have a credit score under 680. Okay, so go back to the LLPA pricing matrix. According to the FDIC itself, an LLPA is a loan level price adjustment. It's basically a risk-based pricing adjustment that varies based on credit score, loan-to-value ratio, type of product, and various other factors charged at either the time of origination or over the course of the loan. See, most lenders convert these LLPAs into interest rates on the mortgage, which the borrower pays over time. Okay, so let's break this down practically, how it actually works. There's a table that gets analyzed when you're applying for a new mortgage on a property. They plot your credit score against the loan-to-value ratio, and that tells them how much of an LLPA fee is getting added to your loan, whether as an upfront fee or turning into a higher interest rate that you're going to be charged over the life of the loan. So let's give you two real-world examples. These are courtesy of Mike Shedlock from mishtalk.com, a website that's definitely worth reading if you're into global politics and global economics. So someone with a credit score of 720 to 739 with a 20 to 25% down payment has an LLPA of 0.5% before May 1st and 1.25% May 1st or later. That's a 3/4 point difference, which takes extra money out of your pocket every month for the same product. For the same property with the same down payment, somebody with a credit score of 640 to 659 will see a drop in their fees from 3.25% to 2.5%. This seems nuts, right? Better borrowers getting penalized, worse borrowers getting rewarded. There's got to be a great reason why this is changing, right? The goal of the program is to expand homeownership. And okay, I can get on board with that. The program is designed also to assist low-income and minority borrowers by encouraging homeownership. I'm pretty sure that if you're watching this channel, you're behind that too. Where you lose me is borrowing from Peter to pay Paul. If you want to decrease the fees paid by borrowers with lower credit scores, go right ahead. I have some concerns about that because those fees are usually meant to cover the lender if that borrower, who might be a greater credit risk, defaults. But penalizing people who have worked hard to save money for a larger down payment and maintained a strong credit rating to subsidize those losses somewhere else is where this derailed for me. Reduce the fees for the riskier buyers, but keep the fees for the better borrowers. That's one solution that doesn't blatantly penalize people with good credit. Or reduce the fees for both and find another way to subsidize those savings. The timing of all this is absolutely terrible too. It's peak spring market right now, every area of the country's busiest home buying and selling market of the year. And rates are back up in the mid 6% range. So buyers have been squeezed by 35 to 50% home value increases over the last 3 years. The interest rates that they have to pay has more than doubled. And now, even if they can afford the same house, they might have a higher fees or a higher interest rate because they have good credit. I'm sorry, but come on, man. Okay, so what do? Should you stop paying your bills on time? Should you pay your credit card late to save on fees for a loan for the house you want to buy? No. 100% that does not make sense to worsen your credit score. Remember, people with scores under 680 aren't getting a better deal than the ones who have better credit scores for the exact same property with the exact same down payment. In fact, if you have good credit, you'll probably pay half the fees of the person with the worst credit, even with these new changes. But before the changes take effect on May 1st, you'd be paying about 1/7 the fees of that other borrower. Drop a comment down below and let us know what you think about these changes. And if you're a first-time homebuyer trying to figure this all out, your next step should be watching our video on the first-time homebuyer mistakes you have to avoid. Okay, so now you know the answer to whether or not people with higher credit ratings are being penalized compared to lower credit borrowers. And yes, I think we answered that emphatically. And you learned a lot more about loan level price adjustments than you ever wanted to know. If you're about to get started looking for your first home or your next home here in New Jersey, please click the link in the description to set up a call with me and my team. We'll get you pointed in the right direction and hook you up with one of our lenders who can explain your options and get you squared away with the best loan for you.